Okay, so I've got with me today Emerson Baker from Bank of Montreal, and rather than dispensing with introductions, because I've already wasted 5 minutes of everyone's time, I will turn it over to Emerson, and he's going to give you a quick introduction to the BMO ETF toolbox, some resources for do-it-yourself investors, and a quick introduction to some of BMO's new ETF portfolios, and of course, one of their newest is the ZZZD ETF. So over to you, Emerson, to talk a little bit about the Canadian ETF market.
Perfect. Appreciate that, Larry. Thanks everyone for having me here, and I'll get right into it. So I wanted to talk to you a little bit about the exchange traded fund market overall, and then some of the tools that are available to you as do-it-yourselfers, so that we can help with. And then also, of course, talk to you about a couple new solutions that we've brought to market. So I'll start here, and I think the important story is the growth of the Canadian ETF market over the last 10 years as a whole. The ETF market is the fastest growing aspect of Canadian finance, and we can see that by the bar chart down at the bottom of the screen, of which BMO has been a significant part of, and it's been an exciting ride, and we're proud to continue to drive growth in this industry. As we continue to feel that we're helping an investors. So a couple stats: we've been number one in net new asset growth for the past 8 years. Last year alone, it was over 20% of the total growth in the industry. And we're very proud to offer that our solutions are helping Canadian investors. We're the number one provider of fixed income in Canada with the lowest cost, but also the most precise ways that you can access that market. A top 10 provider in the world in terms of fixed income ETFs, and we're a very global company as well. Top 20 in assets across the world, and then as well with listings that are in Europe and Hong Kong that we're looking to build out those lineups as well to try and leverage the success that we've had and the value that we've provided Canadian investors in the rest of the world. But with that, I'll get into some of the tools that we're offering do-it-yourself investors. And this is a really great innovation that I think that we've brought to the market. So starting with the ETF Dashboard, we brought this out about 4 years ago. What the dashboard is a central hub for all things Canadian exchange traded funds. And that's not just pertaining to BMO. We find that it's very important to allow investors and participants all types of knowledge. So all of our industry, our competitors' information is available here on this dashboard. And from the dashboard, you can access a series of tools. And so I'll get into those a little bit. We offer three pretty robust tools, one of them being a comparison tool, which is as it sounds. But again, you can compare not just BMO exchange traded funds, but every single Canadian listed exchange traded fund to see what, and it gets pretty in depth to evaluate which type of exposure you would like or what type of product you're searching for. There's also a screener tool, and a good example of when a screener is really helpful is if you're trying to get exposure to a certain type of stock, where the screener will allow you to sort of punch in that stock, and it'll dictate what exchange traded fund makes a lot of sense for your portfolio that has an allocation to that stock, as an example of how you'd use that. And then I think probably the most robust tool is the portfolio builder, and this allows you to create a series of exchange traded funds and start putting together, ways that you can build your portfolio with a cumulative end result. So all of that's available on BMOETFs.com, and the dashboard is just the difference is BMOETFs.ca, and that's available to you at absolutely no charge. And so further to that, wanted to talk a little bit and just set the table of what Larry's going to speak to in much more depth with some. I don't like to use the words common mistakes, but definitely some areas that we are concerned by and hope that we might be able to help with in Canadian portfolios of all types. So the first issue I think which is a really important one is overconcentration. And we in Canada actually have a home, and every country's investors will have a home bias, but we in Canada have one of the most significant home biases across the globe. And the reality is that Canada has some amazing companies. I mean, the financials and energy, but the reality is that some of the time Canada just isn't in favor. So, what exchange traded funds bring to the table is the ability for a do-it-yourself investor to get exposure to geographies that previously may not have been able to access. Um, and so then another issue with this is that is market timing. Market timing is difficult regardless of if you're a professional investor or a part-time investor. It's a really difficult process, and so when you're tied to single stock names, the market timing can be quite important. But obviously, with this being a challenge, an exchange traded fund allows you to sort of diversify your pool of assets so that that market timing becomes less of an issue. Because really, guys, we just don't have a crystal ball at the end of the day. Rebalancing is another big one. We've had a great 10-year run, and so names like Apple or the FANG stocks in general could be dominating one's portfolio now because they've been such exceptional performers. But the issue with this is that also ties you to, again, that single stock risk. So an exchange traded fund that you can access these names through could really help you there, as an example. And I think that the fourth point, and it is a difficult one to handle, is letting emotions take over. And every single person, be them professional or non-professional, are subject to this. And so it's a difficult thing to handle. But again, that diversification benefit can really help battle that emotional ups and downs of the market that you may face. And so just to speak to how absolutely difficult this market is. This is a really good slide, and we use this across the board at BMO. This is just a 20-year time frame and showing you the stark contrast between what investing may have looked like in 1997 up until sort of present day. So all these portfolios are just under about 11% return, and sort of is trying to emulate or show you what you would need to put in that portfolio in order to achieve that return over time. And so in 1997, you could achieve that through Canadian federal bonds, and that was a very prudent way to invest your money and earn quite a nice, healthy almost 11% return. But as we've gone through time, you can see the complexity has increased significantly. So in 2007, you're starting to have to incorporate equities, largely Canadian, but starting to get some global exposure. But the most significant part is that we've reduced our fixed income exposure by almost 50%. And that's a huge adjustment. But really, 2017 is the picture that we're trying to talk to here, and the picture is complex. You've got everything from global equities, emerging market equities, small cap equities. Definitely need some real estate exposure in there, and your fixed income exposure has become quite small. So the landscape has changed significantly, and we need to access different areas, and that's where ETFs can really come in handy. And so what we've done is we've brought out some really exciting new products, and for this exact thing that we're speaking to here. So proud to introduce the asset allocation ETFs. So what these are is, or as per their name, it's a series of ETFs that are allocated to a percentage of equity and a percentage of fixed income. But the beauty of these products is that by buying one single ticker, you've got instant diversification over multiple asset classes. And so we've launched 3 to begin: a conservative, a balanced, and a growth. And you can see on your screen the equity to fixed income allocations within each of those. And so these are great complements to what you're already doing to give you, again, that sort of balanced portfolio nature that's going to offer tons of diversification with a series of ETFs within each of them. And so those are available in any channel, direct brokerage, and they're quite competitively priced, starting at 17 basis points. And then as a final, just for me to wrap up and set the table for Larry a bit, and he alluded to this, obviously, we're super excited to bring this to market. We've had access to Larry Berman and partnered with him for over the last 5 years in a mutual fund platform. It's been an exceptional fund. We now get to bring it to you guys in an ETF platform. I really think that this is a great innovation that we've been able to bring to the market to leverage Larry's expertise at 70 basis points and being able to access that at any given time and help you guys sleep at night in terms of investing. So with that, I'm going to hand it over to Larry for the bulk of this presentation, and I appreciate everyone's time.
Well, thanks very much, Emerson. So that was a bit of an introduction there, and as you could imagine, the road shows we do across Canada, you know, they're not free, and thanks to the sponsors like BMO and others, we are able to do those things for you a couple of times a year. Obviously, not as much cost involved in doing the webinars, but nevertheless, thank you very much again to BMO and through our great partnership with them over the years. So getting into the presentation, how to sleep in a bear market, really, I want to talk about a couple of things today. I do want to go back and do a quick history of bear markets, and I want to give you some ideas about what might be coming up, understanding some of the behavioral side of things. Emerson touched on a couple of behavioral issues that people tend to underperform what they could be doing. So a little knowledge about investment decision making is important. Ultimately, the goal of the sleep at night portfolios that we run, how do we kind of put them together, look at some technical indicators, and hopefully we'll have about 15 minutes to half an hour to answer questions. I know a lot seem to be coming in now, and I've answered a few of them already. But as I go through, we'll wait till the end for the rest of the questions. So moving right along, looking at a brief history of recessions and markets. Why do we care about recessions so much? Well, ultimately, it's GDP that drives earnings and growth in economies and markets. GDP is the way we measure it. The formula for GDP is C plus I plus G, X minus M. So it's consumption. So that's what everybody consumes together with our incomes. It's investment. So that investment could be, building a house for an individual, for a business, putting up a new plant so you can produce more widgets. Could be investing in equipment to frack a well. And then G, it's our tax dollars at work, otherwise known as government spending. And what's very interesting these days is X minus M, and that is terms of trade, what we export minus what we import. And a lot of the volatility around markets today, of course, is really geared towards what's going on now, in the global trade scene. So I'll talk a little bit more about that later on. The other way of thinking about what the natural rate of growth for markets are, because GDP we think of as real growth, so after inflation. So what is growth? Well, growth is two things. It's defined as the natural rate of growth, which is your population. So the more people you have, the bigger your economy is going to be. And then there's this thing called productivity. And what's productivity? The definition is output per unit of labor. So for example, a decade ago when they first started the fracking really in a big way in North America, and I'm making up numbers here, but just for explanation purposes, don't fact check me on this. A rig would cost $1 million and it would take 20 guys to run the rig, and you would get 1 barrel per minute output, let's say. Again, I'm making up numbers. Today, that same rig costs $800,000, takes 5 guys to work, and produces 2 barrels per minute. So your output per investment, per unit of labor, your all-in cost is way better today than it used to be. That's productivity, that's real economic growth. So those two things together typically define what the natural rate of growth is. And because of demographics, in terms of slower population growth and shrinking productivity growth, the same investment, for example, when the microchip first started and they first created spreadsheets with Excel and word processing, the benefit of the version 85,000 that's out today compared to version 1, you just don't get as much productivity today as you did in the past. And this is true going back cycles and cycles. So when you look at the rate of population growth, we're looking at a population growth globally that's somewhat under 1%, in terms of North America anyways, the developed markets. And your rate of productivity now is significantly lower than it used to be in past cycles. So your natural rate of growth looking out for the next decade is actually about 1.5%, give or take. So how do you get an economy that grows at 3 or 4%, like governments would ideally like to see, and what we've seen, in past cycles? Well, this graphic here, and I had a version of this on this week's show when I talked about past cycles and rates of economic growth. And the top graphic, all the green and red bars, those are the quarterly growth rates of the US economy. The thick dashed blue line is the 10-year average growth rate, and the more volatile black line is the 1-year GDP rate. So you can see when that 1-year rate dips down below zero, those red shaded areas, those are the recessions. And I want to show you, what recessions mean for markets, and juxtapose that in this case with the bottom part of the graphic, and in the red line looking at long-term interest rates, or the US 10-year yield. And as we saw many years of rising inflation and higher interest rates going back from the 60s, 70s into the early 80s. And then really from the early 80s till today, we're in a period of falling global interest rates, and I don't think we're done yet. The blue line is the percentage of government debt. So it's the G part of GDP. Now, if governments are borrowing, running deficits, they can mathematically create positive GDP by spending the money. Now, it's okay if there's borrowing and spending, and that rate of borrowing and spending is slower than the rate of economic growth. But when that borrowing and spending is faster than the rate of economic growth, the amount of outstanding debt increases as a percentage of GDP. And why this number is important is because the interest payment on the debt must be paid before anything else, because you can't default on your debt, especially if you're the government of the United States. So we can see that coming out, actually, the blue line doesn't go back that far, but coming out of World War II, where this graphic actually starts, the debt to GDP was about as high as it is today, at over 100%. Wars are very expensive to finance. And as the boom happened, and we saw, women having 3-4 kids, we had a period of 25 years, i.e. the birth of the baby boomers in the 40s, 50s, and 60s, that caused tremendous economic growth. On average, that dashed blue line, real GDP was running at around 4%. We had recessions during those periods because the swing factor in the C plus I plus G is typically the leverage. And that is the government borrowing or the business investment part of things. Consumption, the C part, is relatively stable over time. And the exports minus imports, that changes too, often depending on the value of your currency. If your currency is cheap, you're likely to export more, boosting your domestic economy because more people are working domestically, versus when you're importing a lot of goods, and they may be cheaper from abroad, but those jobs are also somewhere else. So the income and the tax base is lower in your economy. These are some of the things that Donald Trump is trying to fix and address, but I don't think he's going to be very successful at it, because that natural rate of growth today is only around 1.5%, where back in the 50s, 60s, 70s, it was around 4%. You had a real rate of growth in the economy that was much higher than today, largely because women were having more kids, population was expanding, and the early days of the microchip and advancements in other industrial technologies really boosted output per unit of labor compared to the things we're seeing today. So move the clock forward into the middle of the 1980s, 90s. and debt to GDP started to rise significantly as interest rates started to fall, as that red line started to come down. So Reagan cut taxes, stimulate growth, all good, but that average growth rate from the 80s through to the 90s was closer to 3%. It was a full percentage point lower, because at that point already, the baby boomers weren't having as many kids as their parents. So the natural rate of growth came down, and the productivity enhancement from new investment was not the same as it was, initially. For example, when they first built the 400 series of highways in Canada's, there were dirt roads before that. 10% of households in 1950 had an automobile. Today it's 65%, and it's basically been around 65%, for the last 25 years. So when the roads get broken and full of potholes and need to be fixed, it still costs billions and billions of dollars to make those repairs, but you get no economic multiplier compared to when you first built that road and more people bought cars. And then as the highways expanded, Howard Johnson's popped up and a gas station, and there was a real economic multiplier to that infrastructure investment back then. Now the infrastructure is broken, and the airports need repairing, and the hospitals need repairing, and the bridges and the roads, but there's no economic multiplier anymore. So that investment dollar doesn't go as far. And that's really why the growth rates are much lower. So when Donald Trump tells you he's going to grow the economy best ever, it's leverage. The US government this year is borrowing 5% of GDP. So imagine if the US was running a balanced budget today, there'd be 5% less spending by government. GDP would be about 5% lower. So it wouldn't be a 3% economy last year, it would be a -2. And that's the environment we're in. And one of the reasons why I've said for years now that the economy is very fragile, can't handle higher interest rates. And the more that the size of debt accumulates, both on a government and a corporate and a personal basis here in Canada, it's astronomical, the amount of debt outstanding as a basis of income, which is troubling for growth in the future. So I think we're in a low growth world going forward. Doesn't mean we should sell everything and go to cash. Absolutely not. But you have to recognize the environment we're in. Now, recessions are important. Here's a bunch of shaded recessions, and what we're looking at, and apologize, these charts are a little bit dated now, but the message is still the same. What this indicator looks at is the slope of the yield curve, and the probability of recession increases as the slope of the yield curve inverts. So today we have the 3-month rate of US Treasuries at about the same rate as 10-year Treasuries. And so that's a very flat yield curve. And the reason the yield curve matters so much is because banks, when they're financing their lending, they borrow short. They tend to borrow money from deposits, so that's shorter term interest rates. They tend to borrow money by financing bankers' acceptance here in Canada, and they will do euro dollars, so the LIBOR market in the US. It's called the London Interbank Offered Rate, but it's basically the funding mechanism for financial institutions. Well, when that rate is higher than the lending rate, i.e. what can they lend money at for 5 or 10 years, that inversion of the yield curve hurts the profitability of banks. Credit standards improve dramatically, meaning they don't lend to more risky investors, and therefore there's less lending. Where there's less credit expansion, the I part of the investment shrinks. So C plus I plus G is growth, and ultimately earnings are driven off of the economy growing, pretty much. So that's in a nutshell the big picture. Every yield curve inversion post-World War II that we see here has basically either significantly slowed the economy or put us into recession. And that really is a big function going forward. The second thing we need to worry about in terms of economic downturns is what happens to earnings. So typically, if you go study all those recessions, we learned that earnings fall on average about 20% in a recession. And so what should investors pay from a multiple perspective, i.e. how much is the market earning and what should we pay for those earnings? Well, today that multiple is up around 17.5 or 18 times forward earnings. Back in December and January, when the markets were near their lows, that forward PE ratio was around 15. The long-term historic fair value average for the forward PE for the S&P 500 is around 14. And when you're in a recession and a weak economic period, that multiple tends to be 10, 11, 12. And when you're in a stronger growth period like the last few years, it tends to be 16, 17, 18, 19. We've had extreme periods over the years. I'm going to show you some of those as we now go back and look at some of the past recessions. Okay, so Larry McFly is now going to take you back in time, and we're going to look at 3 of the last big bear markets. But first, we're going to look at what happens in recessions and drawdowns. So again, here's our same graphic, with the green line being the S&P 500 presented in a logarithmic scale. So the ups and downs you can see a little bit clearer. With all our recessions, remember all these recessions were caused, and one of the catalysts was the inverted yield curve, i.e. the credit cycle started to contract. At the top, I have measured in percentage terms on the right-hand scale, the percentage of drawdown from the previous high. And so what you can end up seeing here is that in some of the recessions, for example, in the 50s, where we had to deal with the Korean War, those recessions were relatively mild, 10, 15, 20% kind of drawdowns. And you say, well, Larry, in the average bear market, the drawdowns for the US large cap market, in the average recession, the average drawdowns 29%. So why were those lower? Well, when you look at the starting point of those pullbacks in markets, the valuation, i.e. the PE, was actually very, very low. And it was actually about fair value or even below fair value when those economic downturns came. And so the market had an earnings contraction, but we didn't get much of a multiple contraction. Move the clock forward into the early 60s, and you see that first recession in the early 60s. That market pullback was barely over 10%. But look at the one after that, was almost 30%, and there was no recession. What was that? Well, that was the Cuban Missile Crisis. So sometimes markets will correct based on the natural economy slowing. And typically what the Fed's job is, it's got a dual mandate, stable employment and managing inflation. And when we got through into the 70s and the really high inflation, the central banks lost control of that, and they vowed in the early 80s never to do that again. And they've been much more hawks on inflation, and hence the 40 years basically of falling interest rates has been part of that. Demographics are another big part of that. But the corrections started to get a lot deeper into the 70s. Well, why? Well, you had high inflation, you had slightly overvalued equity markets in that case, but you had pretty significant declines in earnings during the high recession periods when the economies turned down. In fact, into the middle 1970s, of course, you had Nixon impeachment, you had the first OPEC crisis, where they had to start stockpiling and created the oil reserves in the U.S., and they had rationing of oil, and so you had a perfect storm. You had geopolitical risk, you had a presidential problem, you had trade issues on oil, and you had valuation, and so that was a much bigger type correction. You had a double dip recession in the early 80s. You had a recession in the early 90s, which was the Gulf War I, but 87 came, there were no recessions there. Why did that collapse? Well, it was from extreme valuation. So we're actually going to look at 87, the 2000 bubble, tech bubble, and then the 08 and 09, 07, 08 and 09 in terms of the Great Recession. And you could see in that last one that was pretty severe. In fact, the most severe since the Great Depression years. That recession in terms of magnitude, that pink shaded area, lasted the longest compared to all of them. Okay, so the graphic here, what we're looking at is 1987. The market got what we called irrationally exuberant back then. The orange line is the trailing PE ratio. We had been looking at the forward PE ratios. So this is the PE that's already in the bank, what we know we've earned. And at the peak of the market in 87, you can see from the beginning of 86, the PE was around 14, went to 20, almost 24 at the extreme. In fact, I think the intraday highs were around 24 prior to the market crashing. The purple line is the 10-year interest rate. The black line is the Fed funds rate, i.e. the short-term borrowing rate. And those green little skinny bars are the rates of GDP. So you could see there was no yield curve inversion. The black line did not go above the purple line. We had no decline in the economy, yet the markets collapsed, and that was the biggest crash in short-term periods since 1929. So what was the catalyst back then? Well, valuation was a big one, but we were having major trade disputes with Europe at the time, and they were accusing Germany of being a currency manipulator and Japan of being a currency manipulator. They were going to put tariffs on auto trading. You know, does that sound familiar, folks? You better bet it sounds familiar. And this is why one of the things that, you know, keeps me up at night a lot is the concern over trade. But ultimately, that was they call it a bear market because the definition of a bear market is a 20% decline in markets. But that was a crash. And there's elements of that in today's market environment as well. And I think if they can't come to an agreement with China between now and the G20 at the end of June, I suspect this trade war is going to get a lot worse before it gets better. And it would not surprise me at the same time if the US then started to put tariffs on Japanese and German automobiles as well, which would I think would significantly take global markets down. Now the tech bubble, again, looking at the orange line, the PE of the market at that point was 30 times earnings. It had never been higher in history, including in 1929 and back in 87. In fact, Alan Greenspan gave a very famous speech in December of 1996 where he first used the term irrational exuberance. And what he was referring to was that the PE at that time in December 96 was around 24, 25 times earnings, like it was prior to the crash in 87. And Greenspan basically said, you know, how are we going to know when, you know, investments are becoming irrationally exuberant? And people were worried about him raising rates at the time, and they had some anxiety. Markets pulled back about 10% over a couple of weeks. But in the late 90s, it was the power of the birth of the internet and the concerns about Y2K and the investment in new technologies. It was so powerful that the downturns in markets were muted and very, very short. 1998, long-term capital hedge fund blew up after Russia defaulted on the debt. That was the first time the Fed put came into play, because Greenspan had called all his other central banks buddies and said, we've got a credit problem that's massive. Everyone needs to cut interest rates. They put out swap lines for liquidities in US dollars, so the banking system globally would have plenty of dollars to borrow if they needed it, and the markets recovered very, very quickly. And ultimately peaking out at 30 times earnings. There are many stocks today, like recent IPOs in Uber and Lyft, for example. These companies make no money. They're not going to make any money for 5 or 10 years, perhaps, yet they're paying crazy amounts of money for it. We're seeing it in marijuana stocks. We're seeing huge multiples in very good companies that barely make any money. So there's elements of the extreme valuation today that we had back in 2000. But the PE today on a forward basis is only around 17 or 18 times. So by historical standards, it's on the high end of average, but it's not extreme. But that's if you don't count all the share buybacks. So interest rates first got put to very low levels in the bust of the tech bubble. As you can see, the Fed funds rate came down to 1% by 2003. And what the C-suite did for most corporations at that point is started to leverage up because money was cheap. They were borrowing money and buying back shares. They've basically been doing it now for 16 years. So if you look at the outstanding amount of shares in the S&P 500, from that point there in 2003 to today, the share count of the S&P is down by about a third. So when you have earnings per share and the share count is less, the multiple is lower. And this is a big, big thing today. If we had the same amount of shares outstanding and the same dollar value in earnings, the forward PE today would be about 28 times earnings, i.e. in line with what we saw in the late 90s. So I think the markets are crazy expensive here. And I get that interest rates are low and there's not many alternatives, but from a risk factor, the markets to me are very expensive. And so when we do ultimately go into that economic downturn, I don't know what it's going to be. I think it's going to start next year when Main Street really starts to feel it and people start losing jobs, and it plays out perhaps even into 2021. Now, a lot of things can come around to change that, but I'm pretty sure the Democrats in the US want a weak economy going into 2020, so their odds are better that Trump doesn't get reelected. You can bet that they're going to do everything they can politically to make that happen, including, if potentially possible, to impeach Trump, including not spending any money on infrastructure to boost the economy before the election. They're going to make that their election promise for 2021 and beyond. The best of the Trump agenda is in the rearview mirror, including tax cuts and less regulation for business. And we only have to look forward to in the Trump agenda negative things regarding trade. And that's kind of my view of the next year. And so I can't see the markets doing well here. And I think we could see over the next year or two more choppy, volatile markets like not unlike this period here. The third big bear market of the last three big bear markets also was pretty severe and the most severe. Now, the yield curve actually did invert here, and it inverted in June 2006 first. The real first quarter of negative growth didn't hit to the first quarter of 2008. And even in that was only less than 2%. The real economic shock didn't happen till Q3 when the Lehman moment happened. And Q4 where you see these 3, 2, and 8% declines, and into the first quarter of 2009, which is another 4%. So the annualized growth rate hit during that period was massive, but it wasn't until the credit shock hit and banks stopped lending with each other and the economy, just really nose spiraled at that point. Massive layoffs, everything came very, very acutely and very, very quickly. Now the markets were starting to discount that risk well into it actually hitting Main Street. But the yield curve foretold the economic downturn, i.e. the credit contraction. It just points out a year or 2 years to where that's going to happen. Remembering that yield curve indicator we looked at a number of slides ago, that was the probability of a recession looking out a year. So that number today is around 27%, and it's starting to get very, very high as the 3-month and 10-year yield curve are very, very flat, i.e. bank profitability is low. So when people say buy the banks, they're cheap, bad idea, bad idea. they're going to get cheaper as the economy weakens. Now, if you believe somehow that the Fed is now talking about cutting interest rates while the US economy is at full employment, and that's somehow bullish, okay, we've got a bet to make, folks, because that ain't bullish. That's a fundamentally weak economy. And remember, the only reason the economy has grown in the last decade at all in North America is the doubling of the amount of debt outstanding at the governmental level, at the corporate level, and at the personal level. It's expanded significantly. So, those are the three kind of big bear markets. And ultimately, what I want to give you some insights into is how to navigate these things. Because I don't know when they're going to start, but putting your head in the sand is not going to cash is never the right thing to do. Because what if it keeps going higher? What if Trump is some miracle worker, he does the best trade deal with China ever, and the markets go 20% higher before this all plays out? And that could very well be. So the question is, when the risk factors are high, what do you do in your portfolio to mitigate those risks? So we see here as the market plays out ups and downs, there's a lot of, in a bear market, and this is the 2000 to 2003 bear market, there were a lot of significant volatility, tradable rallies, even within the overall decline. Those three ETFs that Emerson talked about at the beginning of the presentation, the ZGRO, the growth portfolio, 80% equities, 20% fixed income, and the ZBAL 60-40 and the ZCON 40-60. Those are three globally diversified asset allocation portfolios for 18 basis points, like dirt cheap. And when you think you're closer to a bottom, you want to buy ZGRO and get more growth. This is what I do in my portfolios. I take more risk in terms of equity exposure when we're at a low point. And when I think we're at a high point going into a period of above average risk, I move the portfolio to look a lot more like the ZCON, the more conservative type portfolio. And while markets may slide, I don't care. I want to then find that area of support, wherever that might be, and get invested again and actually trade the ups and downs. Now, not everybody's cut out to do that. It requires being active. It requires paying attention. It requires a minimum, and I'm not talking about day trading here, folks. I'm talking about, reviewing your overall portfolio picture at least once a week, spending a number of hours on it, understanding, the balance between equities and bonds and other asset classes, which I'm going to talk about, because it's the asset mix, folks, that's the key thing here. Now, every year on my show before I go away for the winter break, I do a forecast. And this was the chart that I showed in early December on the US market and how I expected it to play out. And it didn't play out that way. I basically said at the time in my forecast for 2019 that the lows would hold from February. We would get a tradable rally. We wouldn't make a new high, and later in 2019, as the real economy started to slow, those support levels would break around 250 on the S&P 500 and on that retracement that you can see there, and then we would open it up to the downside, falling as low as 1800, i.e. the 2016 lows, by the time the recession fully played out. And kind of find support along the way. That was kind of my call. And it broke a lot earlier than that, and it primarily broke because Trump was belligerent on trade, and when Powell was asked about the balance sheet runoff at his December rate hike meeting, he said, we're on autopilot. And the market just doesn't want to hear autopilot. As the markets were falling into December, I was calling around some of my contacts in New York, and what they were telling me was Trump was calling around to all the hedge funds asking how he could get the market to stop falling, right? Trump cares about what the Dow does and the S&P and so forth. And they basically told him to shut his mouth, stop the Twitter stuff on trade, and you'll be okay. Talk more positive about resolution. And he started to do that. And now, pretty much every day, he's manipulating the market. And it wouldn't surprise me if a lot of insiders are gaming the market today, because knowing when he's going to come out with something and tweet, and when Mnuchin's going to say something, oh, we got a better trade thing. And so the markets, in my mind right now, are very highly manipulated. It's not going to change underlying what the real economy is going to do. But ultimately, you should get used to a lot more volatility like we're seeing now, as long as this trade picture is unresolved. And I don't see a short-term resolution. In the long term, they need one. But to me, China's got no re-election risk whatsoever. They've got deep, deep pockets, probably bigger than the US in terms of what the government can do to stimulate the economy, beyond what the US can do, because Congress controls the purse strings, and Congress, now being Democratic, is not going to spend bags of money to improve the economy before the US election. I'm 99% certain that is going to be a policy plan for the Democrats. And if you don't believe that, again, I think we've got a bet to make. So more volatility rather than less is coming. So ultimately, what do we do about this thing? I think you've got to understand the decision-making process, and the core essence of that is embedded in the origins of behavioral finance. I like talking about this cycle of market emotions and what ultimately drives us. But when we've been in a period of above average returns, and people look back at their returns in their portfolios and they're all green and you're making money, and you're pretty happy about that. I think ultimately that's a very, very risky point in the market. So I'm looking to get more risk off, or rebalance my portfolio into assets that will fall less. And so ETFs that have covered call strategies, ETFs that are less cyclical, less exposure to the economic cycle, and so forth, when we're, in our estimate, we're closer to a top, because that's the point of maximum risk relative to return. But what most people do is they look in the rearview mirror. And after a period of significant declines, having sat through that and not done anything about it, that's where people feel most depressed and despondent about their portfolios. But that is the point where they should be taking more risk, i.e. when we recognize we're closer to euphoria, have ZCON-like portfolio, and when we're closer to depression, have more ZGRO portfolio. On an individual basis, what those portfolios are going to be a means test for individuals. And the most important thing all individuals can do is have a thorough financial plan done with a financial planner, and understand what type of return you need to get from your portfolio, so that when you get into your retirement years, you can sleep at night. You won't have to care what's going on in the ups and downs of the market. That you know that you've got a portfolio, you're on top of it, you're making some asset allocation mixes. In fact, asset allocation is far, far more important than security selection. So Kahneman and Tversky are the two Israeli psychologists that got together in the 1960s. 1979, they created prospect theory, were given the Nobel Prize in economics in 2002 for this theory. And basically, it's the understanding of how people process gains and losses from an emotional standpoint. So you've got on the x-axis, you've got gains and losses. On the y-axis, you've got your emotional response, i.e. above the line, you're happy, below the line, you're unhappy in terms of psychological value. As it turns out, for small gains and losses, people are twice as unhappy with the loss as they are with the gain. As that gain increases, their level of happiness diminishes. As that loss increases, their level of unhappiness increases. And so you get a kink curve in the return risk ratio. And this is how people think about their portfolios, i.e. they get depressed at bottoms and they're really happy at tops. And you've got to, once you're really happy, you've got to start being concerned about the go forward. That is the essence of asset allocation and understanding what and how to build a sleep at night portfolio. So for me, the ZZZD Global Sleep at Night Dividend Portfolio is about generating a portfolio for income and growth in the long term, focusing on minimizing the downside periods when they come. And they're always going to come. We can't forecast how long they last, how deep they're going to go. All that is nonsense. Don't even bother trying to figure that stuff out, because it's very, very difficult. Having said that, you need to understand what the risk factors are, so when you know when you can be more tactical, or i.e. take less risk or more risk in your portfolio. So for me, I think about investing like I'm playing poker or blackjack. I know the odds, okay? So all the investment decisions we make in terms of when to take more risk and when to take less risk is all about understanding the odds. So I equate the game to blackjack. If the dealer's got a 6 and you have 2 8s, what you should do, because the player has an advantage, significant advantage at that point compared to the dealer, is double your bet and split your cards. Now, if the dealer has an 8 and you have 2 6s, you're statistically stupid to do that, because then you're gambling. So you want to bet more, you want to have more beta risk in your portfolio when the odds are favorable, and you want to reduce your bet or beta in the portfolio when the odds are against you. So right now, there's far too many factors in my mind that are more negative, including the debt, including Trump, including the weak economies globally and specifically in Europe. The fact that debt is the only thing that's boosting growth in the world. All those things to me are big risk factors, because when markets correct, as we've seen, when the PE is higher, the corrections are deeper. And so we have to be alert to that. So here's where it ties into the charts for me. So I look at trend, momentum, sentiment. There's about 20 different factors that we look at. So when I'm evaluating trend, for example, I use a linear regression, and I say, well, what's the slope of the current 1-year market? And at this snapshot in time in January, and more specifically at the bottom in December, we were more than 3 standard deviations below a zero return market. And I can go back in my database and look, going back to 1926, where I have daily data for US large caps, and I can figure out what happened historically when we were in a similar circumstance. And that actually gives me a good probability. You know how when you're watching Poker Stars or one of those poker things on TV, and they show you the probability of the person winning the hand based on their cards and what everyone else has and the flop and so forth. That's exactly what we're trying to do. We're assessing based on where the market is today and its behavior, based on trend, momentum, sentiment, seasonality, volatility, lots of different factors, what's likely to happen over the next 1 month, 3 months, and 1 year. And so we calculate those numbers every day. And what was basically happening in December was that the probability of a recession at that point was very, very low. And the average correction in absence of a recession is around 10%. The average overall correction, including all recessions, is around 13.4%. And the average correction in a recession is around 29%. So in absence of a recession, the probability of a correction going much more than 20% is almost zero. It's not zero, but it's almost zero. So having a 20% pullback from the peak, when all the indicators were telling us over the next 3 months or so, markets are more likely to snap back and rally, that's the time you need ZGRO. And in our portfolios and the sleep at night portfolio, that's when we're making a lot more of a bet in terms of our exposure to global equities. So while we were nervous about the markets in June, July, August, September, and taking off risk every time the markets went up a little bit, Now, when the markets go down, we've got a lot of less risky assets that we could sell, like bonds, like gold, and get back into the S&P 500 and the parts of the market that are going to rally more when equities do better. That's the secret, folks. It's asset allocation. ETFs are just very elegant. I don't need to figure out which 20 or 30 or 40 stocks to buy. I just need to know that if I buy the S&P 500, I'm getting 100% of what the S&P 500 does. And if that's good enough for you, then ETFs are the solution. Not worried about what stock to pick in terms of the portfolios. So there's lots of indicators. I'm not going to run through all of them. I do want to leave plenty of time for questions. So let me get into the portfolio side of things and kind of leave some of these other indicators for now, because it's the asset allocation and how you build your portfolio that's really, really super critical. And yet you kind of have to understand that if you go back and look, what are the driving factors that ultimately are meaningful for your end return as an individual investor? It's your asset allocation. It's what tools you have in your portfolio. So when we want less risk in our portfolio, lower beta, we want to be less sensitive to the global marketplace. We want ETFs that are focused on high quality companies. BMO's got a suite of high quality selection of stocks for the Canadian market, the global markets, US market, etc. They've got the low volatility ETFs. These are ETFs that are less sensitive to the economic cycle. Companies that are more mature, more blue chip, that have higher quality dividends, good free cash flow. Those are the high dividend quality payers. Not stocks that have a 10% dividend because the company's going down the tubes and the stock's falling and the dividend's rising. A company where the price of the stock is falling and the dividend is rising, that's not a good company. That's not a good idea to buy that, because typically those dividends are going to ultimately be cut, like we saw again. There was an example today. Value tends to be better at times, and ETFs with option strategies, i.e. the put right strategy, is less risk at this point in the cycle, compared to the higher risk ones that are the growth, the momentum, the NASDAQ type stocks, the small caps type stocks, or the cyclicals that have more leverage to the economic cycle. Those are how you kind of think about moving things around. There are a couple of ETFs that were launched last year by a firm called Innovator ETFs. And I really, really like these to play defense for people, i.e. when you're not sure about the downside risks, like now, these ETFs are good. They have option strategies embedded in them that protect on the downside. We've been using strategies like this for the portfolios we run, not for Bank of Montreal, but for our internal clients, where we put in a degree of put protection in the portfolio so that we can still invest and generate yield and dividends, but mitigate the volatility in markets. So here's a series of ETFs that allow you to kind of do that for those of you who think you might want to do these things on your own. And I highly encourage you to go to the Innovator ETF's website, read the documents, and learn how these work. So basically, the orange line is the full S&P 500, and the decline that we saw from peak to trough, there being 20%. The white line is the 9% power buffer. So there's an option strategy embedded in that ETF that over the year that it's outstanding will protect the first 9% of downside. And so as that ETF plays out during the year, those options are marked to market and you still have volatility. But if the overall S&P starts falling below 10%, then you're not protected. So the white line went down more because there was less of a buffer in the portfolio. The yellow line, the dotted yellow line, is a 15% buffer. So the first 15% is protected. And so that had less downside volatility. And finally, the red line is the 30% buffer, where the first 5% is not protected, but the next 30% is fully hedged with an option strategy. The thing that's neat about these ETFs is you're still able to make somewhere between 6 and 10% in any given year of the upside. So you're not just protecting the downside, but you can still make upside if the markets keep going higher. So here's the situation where if you see that the markets are at a risky juncture, like they are now, you're worried about the markets maybe falling 15 or 20%, that you move into ETFs like this that will go down less during the decline. But what we were doing in our portfolios, so we were unwinding the hedges as we liked actually the overall value of the markets back in December as things were selling off. So we got out of our more defensive ETFs, our high quality, our low volatility, our high dividend, our option strategy ETFs, back into the S&P 500. So when the markets rally back, we got 100% of the upside. So when we changed the beta in our portfolio to be half or less of the target, and what that target is for us in our global dividend fund is about 75%. So in any given year, you can expect us to make somewhere between 3.5% and 4% in dividends and capture 75% of the upside in terms of growth in the marketplace. But on the downside, when we're risk off, we put the risk in the portfolio to half or less, so that if the markets fall 20 or 30%, we're going to fall 10 or 15. We're not going to eliminate the downside as things are playing out. Just like these ETFs, they don't eliminate the downside, they mitigate it. But at a point in time when the value's better, you get out of the defensive ones, you get back into the more aggressive ones, i.e. you sell your ZCON and you buy your ZGRO, in the middle of December, as everyone else is panicking in fear, and you have confidence that the probabilities of us going into a recession now and the bigger correction is low, and this is the time to make the bet. Now, if you do nothing with your portfolios when the risk factors are higher in July, August, and September in terms of turning down the risk, you're not able to change your emotional state and turn up the risk when the probability is best relative to the risk. So those are the secrets of the sleep at night portfolios. And so what I'm trying to do is I'm valuating each ETF as its expected Sharpe ratio. And what that means is if I'm going to add today the S&P 500 ETF, and it doesn't matter which one it is, the BMO or the Vanguard, any one that I'm putting in my portfolio, what do I expect to make over my horizon, being 1 month, 3 months, and 1 year? I look out that period, compared to sitting in a risk-free asset, like a money market ETF or something like that, where I've got no volatility in my return or much less volatility, okay? And the standard deviation is the volatility. So it's return relative to risk, and we optimize the portfolio all the time to generate the highest return with the least amount of risk. Folks, that is what I try to do all the time in the sleep at night portfolio. So when you're building these things together, you have to understand correlation and how all these things kind of come together. So what correlation is the price movement of two things going up and down together. And so if you own the Vanguard version of the S&P 500 or US large caps, and you own the iShare version, and you own the BMO version, and you own a mutual fund that's a Canadian large cap, or US large cap, you're basically uncorrelated. They're different labels, but you've got no diversification in terms of your exposure. And so that means you're going to have more volatility. In order to reduce volatility, you must be able to bring in different classes of asset types that have different types of returns. That is the secret sauce of portfolio construction. Now, ETFs, again, just make it very easy. So what I'm highlighting here is an example of the correlations between different types of ETFs. And I've basically got a universe focusing on the US market, as I often do, because the US is half the world index. So SPY being the S&P 500, XLF is the financial sector of the S&P 500. It has an 82% correlation with the broad index. The healthcare sector, XLV, 86% correlation. The consumer cyclicals, XLY, 91% correlation. Look at utilities, 22% correlation with the broad market. So a low correlated asset is going to give you diversification benefits. But look at when I compare XLU to XLF, the correlation's almost zero. So if I add utilities and good paying utilities dividend-wise and good paying financials dividend-wise in the US, those two things are not correlated. I get a lot of diversification. So those two things are good things to build in my portfolio. But when I put in XLY and XLI and XLB, the materials, and IYW, the technology, those are my beta. That's the market going up. Okay, so I want more of those that are going to be higher beta when I'm bullish, and when I'm bearish and concerned, I want lower volatility asset classes. IYZ is telecoms. So again, good dividend payer, less correlation. But look at some of these other asset classes. AAG, that's the entire US bond market. It's actually negatively correlated. Gold, negatively correlated. Exposure to the euro, zero correlation. Exposure to the yen, negative correlation. There's lots of different asset classes that we can put into portfolios in terms of exposure to get that sleep at night effect, i.e. increase our diversification, lower our correlation of assets. Very, very important concept. I often get asked questions, and I've seen some come in terms of the FX. When do I hedge? When don't I hedge? So basically, what I've done here is I've put the S&P 500 in there in terms of the orange line, and that's the base return of the US market. And then 4 ETFs, the BMO hedged version, ZUE, the unhedged version, ZSP, and then 2 versions in the US, SPY, where one I'm looking at it in Canadian dollar terms, and 2 I'm looking at it in US dollar terms. And when you look at the difference in the table of returns, currency becomes a major, major, major factor in terms of the end result. So when do you hedge and when not to hedge? This data here is a little bit old. I think in the trough of the next recession, we're going to 68 cents versus the US. If we're under a liberal government, probably closer to 62 cents because of their anti-pipeline stance. And that's just going to be bad for our economy and markets. I get there's environmental issues. I'm not talking about those. I'm talking about what are the economic impacts of policy. And in this case, it would drive us to more even weaker Canadian dollar. But even under Andrew Scheer, if we get a conservative government, currencies are still heading lower in an economic downturn because our biggest and best commodity, energy, gets depressed in terms of price when the global demand falls and we go into an economic downturn. So right now I'm playing about a 75, 76 cent range to around 72 or 73 on the downside. I'll hedge at the lower end, I'll unhedge at the higher end, and we'll move that currency exposure around. This table here goes back to 1972. Once we broke the Bretton Woods standard and the world came off the gold standard, currency started to float. And so Canada, US, Canada, Euro, Canada, Yen, Canada, British Pound, some of the major currency blocks in the world. The average impact on an annual basis, Canada, US, is almost 5.4% in terms of what the currency return is, either hedged or not hedged in your portfolio. And when you're buying single stocks like Apple, great stock, can't hedge the currency. But if you bought ZQQ, the BMO NASDAQ 100 currency hedged, you would get that Apple exposure, you'd get others too, but then you don't have to worry about the currency, it's completely hedged. When it comes to Europe, this graphic shows the return of the German DAX in blue and the S&P 500 in orange. You can see they go up and down together, so they're correlated, but their returns differ. And in percentage terms, the green line, when it's rising, Germany's doing better, and when it's falling, the US is doing better. the bottom line is the currency impact. So when you measure the currency impact as a percentage of the total return, what you see for major developed markets like Europe, Japan, and the British pound is that the currency impact is the biggest single factor. And there are ETFs to hedge and not hedge. So in a global portfolio like we run, like the Sleep at Night portfolio, where Canada is 3% of the world index and most of our exposures are global, currency is a very, very important asset class for us. And with that now, I will start looking at the question database, and I will respond in an audio way, not in a electronic way. So let me get this going here. Lots of questions coming in. I guess a number of people, I guess, had an impact with some the audio and video along the way, and apologize for that. That's probably more of a local issue than a broad issue, given that I still see a huge attendance on the portfolio. So someone's asking, is there a significant difference between ZZZD and the D series ETF? There's no difference at all. They're identical except for the fee that's charged. The discount class fee is still a very, very low overall MER of around 1.1%, but a portion of that goes to the discount broker, where if you buy the ZZZD, you pay your $9.95 or whatever your transaction fee is one time, and the MER is 70 basis points. So which one you own is going to depend. If you're doing dollar cost averaging and you want to put in $50 or $100 a month or something like that, if you do that in the D class fund, there's no charge for those transactions. But if you were buying ZZZD and buying $100 a month and paying $9.95 to do that, well, then your cost of transaction every time you buy is 10%. And so that you have to look at that as to which one's more appropriate. But for longer term buy and hold, for the vast majority of people, ZZZD is going to be the same identical portfolio, but a slightly lower fee in the long run. What else here? Since the market is forward looking, what's the difference between investing in the TSX and TSX futures? Well, the difference between forward markets and spot markets are cost of carry. So if you have an exposure to a future price, there's a cost of carrying money over that period. So the higher interest rates are, the higher that forward price tends to be. And as it narrows to maturity of that future price or that futures contract, you lose that time value of money. So there's always a premium when the new contract comes, and you kind of lose that, because holding a futures contract, you're only putting up margin, where theoretically your cash is sitting earning money in a money market fund. So it kind of offsets that what you're earning in income. I hope that explains a little on the forward markets there. I've stopped out of some US dollar shares lately, and any suggestion of placing short-term fixed income like floating rates perhaps. So Lawrence, floating rates are good instruments. I still have some in the portfolios, but less than I used to. They work best when interest rates are rising. I don't think the Fed's going to cut interest rates anytime soon at full employment, although the market's starting to price that in. Floating rates, ETF, if the Fed starts cutting rates, is going to underperform significantly. So not a good place to hold cash. If you think rates are going to keep going up, then yes, floating rate ETF is beneficial. Will the dividend yield secure in ZZD? Will it change much over time? So my target is 100 basis points over the yield of the entire world. So if you look at the Vanguard Total World ETF, VT, the current yield of that is somewhere around 2.8%. So I target 100 basis points more than that. And as whatever the dividend yield of the world is, that's my target. And it'll change over time. What's happened in the last 15 or 20 years is companies on average have been paying out less in the way of dividends and using their free cash flow to buy back shares, boosting earnings per share. I talked about that before. But the dividend payout today in the S&P 500 is around 1.8%. The world is around 2.8. So where's that yield coming from? Well, most of it's global. The TSX yields around 2.8 right now, you probably know. If you get a dividend-weighted ETF like ZDV, it's around 3.5. If you go to a covered call dividend focus like ZWC, you can get over 4. So there's different ways to get different exposures, and we move them around in the portfolios based on the different kind of holdings we want to have in our portfolios. Question here on can I compare the performance of innovator ETFs with ZCON at this time? Which is the safer bet? So ZCON has 40% global equities, 60% bonds. That is going to give you a similar ride in terms of the volatility and downside as probably the 15% buffer ETF. But again, what you have to do at some point, i.e. if we go back towards the lows that we saw in December, at some point you've got to get out of that ZCON and go back to ZBRL or ZGRO. And that's the only way it's going to work for you. But they would be similar. They don't hold the same things, but there's exposure to US large caps in the ZCON. It's typically going to be about 40% of the equity exposure. So you would have more exposure, but you've got that option hedge. Hopefully that answered your question there, Rena. Question about blockchain technology. Would I suggest a Bitcoin? No, I said I got asked about Bitcoin. Investing in blockchain is not Bitcoin. You own nothing when you own a Bitcoin. What you own is the next person's willingness to take that asset from you. Okay, and I believe Bitcoin's worth 0. You can speculate on if you want, but I think it has no inherent fundamental value whatsoever. I do think the world is going to move to electronic money in the future. Central banks will control it for sure. There probably will not be independent currencies. And if they are, they're going to be exceedingly volatile, like a Bitcoin. So it can be speculated on, but not invested in. Be very, very clear on that. Investing in blockchain, however, is different. The blockchain technology that powers what Bitcoin's all about is very, very interesting. Hundreds, if not thousands of companies around the world are investing in blockchain technologies to improve productivity, i.e. productivity enhancement. But a lot of that blockchain productivity enhancement is actually going to eliminate jobs. If they can figure out trading, for example, on a blockchain technology where you have instantaneous settlement, meaning the trade between stock A buyer and stock A seller happens right away, it's recorded in blockchain, the whole back office function of the entire investment industry is out of business, replaced by a blockchain environment. That would probably be 5 or 10 million people out of work around the world. So that's blockchain. And I think it's very disruptive and very interesting from that perspective. The industry is extremely new and very early. And in industries that are very early and don't have stable revenue sources, this applies for everything, including marijuana and new technology companies like Uber. When the economy turns down, money runs like crazy from things that don't have positive cash flow. Because if they need to go to the debt markets or equity markets, it's dilutive or it's very expensive and a hit to earnings. That applies for everything in the investment world. We're in that part of the cycle now. Do not speculate, and if you do, be prepared to pay the price of volatility. I'm in the US. Is there a recommendation in the US similar to my fund, ZZD or Grow or Zcon? Unfortunately, I don't know the answer to that. I'm hoping in the next couple of years we're going to have my funds available in the US, as well as BMO, I know, is looking at an ETF business in the US, but I can't speak to their plans or when that might happen at all. But I know they're considering it. Please show the slide of the 3 ETFs again that make up the portfolio. Irwin's asking. I don't know if there's an easy way I can do that on my slide deck here, unless I'm just gonna go rifling back through it like this and bring that up. So we're almost there. There we go. We're 3, 4, 5, 6, 7. Slide 6. So there you go. If you can still see that, Erwin. Basically, you've got a exposure to Canada. I think a little bit too much, mind you. You've got exposure to US large caps. You've got exposure to international developed markets, and you've got exposure to emerging markets on the equity side. And so those same ETFs in all of them, the weightings are just a little bit different, okay? How are we doing here? We got about 5 minutes more for questions. Why would I buy ETFs over individual stocks, or should I have both? Tom, that's an excellent question. The answer is an individual choice. I like ETFs because I don't have to be a stock expert. If you think you can find the best 25 or 30 stocks that are going to do better than the S&P 500 than just simply buying one thing, good on you. The entire world of portfolio managers, all the professionals in the world, after the cost of investing, don't beat the market on average. You have to understand that. It's much, much harder to do. And in a fund structure, you have some other benefits too. So asset allocation between stocks and bonds, for example, if I want to change my portfolio from looking like 60-40 fixed income to 40-60, it's simply could be one ETF, US equities, and saying going from 16% to 36%, and taking the bond ETF, Canadian aggregate, from 42 down to 22. And within one trade, my asset mix has changed. What you would have to do is sell 5 or 10 or 20 stocks and a bits of each of them and buy 8 or 10 different bonds. And that's just more expensive and way harder to do. And in active markets, I think ETFs are very, very elegant for asset allocation. Now, it's very, very true that when you buy the S&P 500 companies, there's some stinkers in there, but that shouldn't matter to you. You should get that the benefit of diversification is far, far more important. Now, if you're the type of person who wants 20, 30, 40, 50% returns, and you want concentrated portfolios, that's not me. I've never been that guy. I never will be that guy. I like low risk. I like conservative. I like asset allocation. I like a sleep at night portfolio. So I don't know if that answered your question, Tom, but thanks for that question. What's the best ETF to get exposure to US large cap stocks? The simplest thing is the S&P 500. If you go back and look historically from 1926 to today, where I have daily data for US large caps, and you go back and look at all the mutual funds, frankly, if you look at Berkshire Hathaway from 1998 to today, the S&P 500 has done slightly better. And it's a low cost exposure within an ETF. It's great. So just buy the main index. If you want to get a little bit in terms of a better risk and return, you can buy some of the smarter indexes that might be an equal weight version, or some that might equal weight the sectors, or some that might be small caps instead of large caps. There's all kinds of ways to build portfolios with ETFs. There is no one ETF you could buy. I know everybody wants that, but if you're looking for just one, buy an equities, buy the Vanguard Total World ETF. It's 18 basis points, trades in New York, ticker symbol VT. It's every stock in the world, large, mid, and small cap, and you're going to get the world return for a very, very low cost. Okay, what's the best tool to determine portfolio efficiency, correlations, etc., and when you hold how many ETFs? So in the presentation that we saw at the beginning from BMO, they've got some portfolio tools here, and I would encourage you to go to that website. You can actually build your own portfolios and do some back testing and kind of get a sense of what efficiency really means. But again, it could be 3 ETFs. So Vanguard Total World Equities, Vanguard All US Bonds, Vanguard World Non-US Bonds. Those 3 ETFs make up the entire world of stocks and bonds. So again, it depends how diversified you want to go. It depends how risk off you want to go. There's lots of different ways to build and conserve and things like that. I've got time for one quick question here. Tom asks about leverage ETFs and how do I feel about them. They're not good for holding any more than a couple of days. The leverage rebalancing will erode the net asset value in the long run. Go back and look at the history of all of them. They all typically will lose value relative to their underlying indexes because of that and how they rebalance every day. If you want to speculate and you're a day trader with leverage, there's nothing wrong with them at all. But if you're of the mindset where you're going to hold something and keep holding it and holding it and holding it and holding it, hoping to get even, don't use the leverage ones. They will kill your portfolio in the long run. Folks, it's 3 o'clock. Thank you for joining us. Apologize again for the technical issues up front. Hope you've enjoyed it, and you'll get a feedback survey tomorrow in an email. There'll be an opportunity to make a donation to one of our charities. If you can support Alzheimer's research at the one of the best hospitals in the world, the Baycrest Hospital and Foundation here in Toronto, that does global research in dementias and Alzheimer's, and or at the Sick Kids Hospital for cancer research in children. We very, very much appreciate any support you could provide, and there'll be links for you. And there will also be downloads if you want to download the portfolio. And starting probably in 48 hours, the seminar will be available for replay. So with that, that's it for today. So thanks for joining us. Have a good day.